Hi everybody, welcome back to another episode of Explain the Stock YouTube show. I'm Aziz and today marks the beginning of a new calendar year, 2025. For this new year, I thought we could do a deep dive on the industry that performed exceptionally well in 2024, semiconductors. As usual, we'll be using explainthestock.com platform, and if you haven't used it yet, we've released a logged out experience that allows you to search for companies even without signing up. So go visit explainthestock.com and you can run searches without being signed in. Of course, there's a limit of what you can do without being signed in, so you won't have access to earnings transcripts, trading activities of these companies. You won't be able to add them to your list of favorites, but you can still have access to their financials for free at any point in time. So head over to explainthestock.com and start looking for whichever company you're interested in. So 2024 was marked by another exceptional year in the semiconductor industry. But for that, let's sign into the Explain the Stock platform and let's have a look at the performance tracking functionality. So if we look at NVIDIA in 2024, NVIDIA had another exceptional year, almost providing a return of 3x for its investors. But it wasn't the only company that performed exceptionally well. Broadcom also performed really well, and TSMC as well. This performance tracking view allows you to see the performance of any given stock for a 1 year time frame. And as you can see, all three of them provided over 100% return for their investors. But a lot of people rushed into saying that all semiconductor companies are due for a correction. They are overpriced, and if they're not overpriced, investors expected them to outperform every single one of their estimates by a landslide. And that's what you've seen with NVIDIA. Even though they beat their estimates quarter over quarter, the pricing momentum did not follow that beat. And all the bears out there predicted a major crash, that this is bubble territory, that it could happen at any time. But the truth is, not all semiconductors performed exceptionally well that year. If we have a look at, for example, ASML, which is flat over the past year. If we have a look at Qualcomm, provided around 10% return over the past year. And if you look at AMD, which provided a negative return to investors over the past year of almost minus 11%. And that's a pretty big gap when you compare that to NVIDIA that provided almost 3x return for their investors, Broadcom over 2x, and TSM over 2x. That's a pretty big gap compared to these three. And in fact, if we have a look at this ETF, SMH, that tracks the biggest semiconductor companies out there, on average, SMH returned 46% for their investors in 2024. That's quite a commendable return. When you look at SPY, the indicator over the S&P 500, when you look at QQQ, both of them, and QQQ is an indicator for tech stocks, both of them are in the mid-20s, which is already quite a lot. And if we also compare that with gold, that also provided a mid-20s return last year, actually around close to 30%, generating 47% is quite a commendable outcome for the ETF SMH that tracks the biggest semiconductors in the industry. Just to put things into perspective, a 25% return year over year, after 3 years, you'd have doubled your money. So if the market generated a 25% return for 3 consecutive years, you'd have doubled your money. And that's how incredible the market has been over the past 2 years. In 2023, it was also in the low 20s. And that has been 2 years back to back, quite an unusual performance from the market. But let's dive a bit deeper on the world of semiconductors. And I can attest that the world of semiconductors can be a bit intimidating at first, but let's unpack it together to understand the different players in this industry. But don't worry, this won't be a dreading series of acronyms and terminology and jargon that nobody understands. We'll use an analogy of cooking, in fact, of baking, to describe the whole semiconductor value chain. At the beginning of this chain, you have the company that makes the oven and the molds for the different types of cakes. Oven uses different technologies that require different type of molds, and that's how companies in this space differentiate themselves. ASML, Applied Materials, all of these are companies, Applied Materials, all of these are companies that provide ovens and molds for bakeries to bake their cakes. These companies don't bake the cakes themselves. They just ensure that bakeries such as TSMC have the best tools to bake the cakes based on the designs that their customer requests them to. Which leads us to talk about the bakeries. And TSMC is one of the world's most famous and top bakeries out there. In fact, they use ASML machines and ovens to turn wafer dough, in a way, into high-performance cakes for many of their customers. NVIDIA is one of them. But what's really important to realize is that they're not the one who design what the cake should look like or what frosting should come on top of that cake. They actually follow recipes that are detailed by their customers, such as NVIDIA. The expertise of companies like TSMC really lies into producing at scale with a very high precision. And finally, the last player in the market are the recipe creators, the chefs out there, but they're also the people that sell the cake to end users. And NVIDIA is one of them, right? They're one of the most famous chefs out there that create those recipes of chips that they give to TSMCs, the bakeries, and eventually sell those chips to different companies out there for different purposes, right? So you might buy a cake for a birthday party, but that cake will be very different from a cake for a wedding, right? In the world of semiconductor, the chips that are used for gaming are very different from the chips that are used for self-driving cars, IoT devices. Not all chips are manufactured the same or for the same purpose and require the same precision. So different chips would need different recipes. They collaborate with companies like TSMC, bakeries, to bring their recipes to life, and then they sell them to the world. And they really excel at this process of innovating and branding and creating recipes and cakes that people love and can't wait to eat, in a way. But so far, only a selected few companies like NVIDIA have ripped the reward off of the whole AI revolution, right? Very little companies out there make money off of this AI revolution, but NVIDIA and other recipe makers out there do. Bakeries such as TSMC are also starting to get the second-hand effect from the success of these chefs that they partner with. And my prediction is that in 2025, the tool makers will experience some of that positive impact. And here are a few reasons why I think ASML is due for a benefit from this AI revolution. The first one is that I still believe that the market is supply constrained. As semiconductors usage and demand continues to grow, I think that we are still living in the very early ages of the usage of chips, and chips are going to be in a much bigger demand tomorrow. The self-driving car industry, we're still scratching the surface of that industry. Today, most cars are still operated by humans, but in the future, I don't think that's going to be the case. And for that, they're going to need a lot more specialized chips, such as GPUs. And you can see that the market is supply constrained because companies like TSMC do expect more investments to be done in their foundries, and that will translate into more revenue for tool makers such as ASML. You can see, for example, in this report generated with AI with ChatGPT, analyzing the earnings call, that TSMC leadership expects higher capex, meaning that they expect to invest more in advanced technologies for their foundries, and all of that is directly extracted from the earnings call for you. Well, another reason why I believe that tool makers in the specialized chip industry will outperform the market in 2025 is that the purchase cycle for these companies is much longer than the purchase cycle for NVIDIA. Right? They experience a lag compared to the demand in the market. Well, the oven created by ASML are gadgets that cost around $300 to $400 million each, whereas NVIDIA GPUs can range between a couple $100s to a couple $1,000s. So the demand from the market is much more sensitive on players like NVIDIA than on players like ASML. That being said, once a purchase is secure for an oven, the flywheel effect is activated. Now, in addition to the revenue that they made off of the sale of that oven, ASML will also sign contracts to service those ovens for maintenance so that they're able to get a recurring revenue through these contracts and maintenance. And you have really that flywheel effect that gets engaged. The more ovens they sell, the more servicing, the more maintenance contracts they will be able to sign as well with their customers. And that's a major reason why I think ASML has a bright future ahead of them, combined with the fact that the barrier to entry in this field, in the tool maker value chain of semiconductor, is incredibly high. These are technologies that took decades to mature, so the barrier to entry for any competitor is really, really high. And companies like ASML dominate for decades because of that. And this should be music to the ears of long-term investors. Essentially, ASML market dominance is unlikely to be challenged even as the industry grows, as long as their technology remains the technology that is used to make the chips that are in demand. And if that's the case, then they can impose their higher prices, they have essentially a pricing power, and they can get high margins from that pricing power. They are in a relatively niche industry, highly sought out products, and as a result, they will have pricing power. So we'll see in the revenue breakdown here is that they are essentially one of the only player that provides the EUV products, and their growth year over year has been in the mid-20s. And that's something that comforts them into the leader in that specific type of product. But recently, ASML short-term investors acted on the news of some legal scrutiny. If we go to the news tab, we can see that ASML has been subject to a couple of class action lawsuits, which triggered a massive sale from short-term investors. And here's the complete breakdown of why I think this is a buy opportunity for long-term investors. Despite that class action lawsuit, the financials of ASML haven't been affected. In fact, they're still quite massive. A company out there, over $270 billion in market cap. Their revenue continued to grow year over year. Their profit margin are stabilized. If we look at the financial ratios, the profit margin around 51%, their operating margin trailing 12 months around 30%, very healthy business. They're able to diversify across different regions, not just Taiwan with TSMC, but also the United States, China, Japan. So they're able to really diversify geographically, which will bring more resilience for their revenue streams. And if we have a look at their PE ratio, their trailing 12-month PE ratio, substantially below the PE ratio for the Nasdaq in this industry, right? The PE ratio for ASML is trading at 39, whereas the industry PE ratio is around 64 for semiconductors in the Nasdaq. However, and it's important to highlight what are some of the risks for ASML. If we look at their free cash flow year over year, there is a a decreasing trend year over year that does look worrisome. And if we go even in the quarterly view, that will be even more highlighted. It's something that the variance of the free cash flow is something that could scare off investors. But this is something that leadership has highlighted in their earnings call. So if we look at 2025 outlook, leadership highlighted some of the reasons why they've adjusted downwards the revenue, and it's mainly derived by some market dynamics around some of the older products that they used to sell. But I wouldn't be too worried about this, because this older technology is something that generally has a lower margin than the newest technology that leverages EUV lithography. This is something that leadership had to mention. I'm much more optimistic with respect to the positioning of ASML, especially because of their technology and the type of chips that they can manufacture with that technology. And this brings us to the second point that I wanted to highlight about ASML, and it's strategic positioning in the semiconductor supply chain. I alluded to it. One of the strongest suit of ASML is their EUV technology, extreme ultraviolet lithography, and that's one of the technologies that they have a monopoly on. They are extremely advanced in that technology, and none of their competitors is even closer to their advancements. And as I mentioned earlier, this technology takes decades to get developed, so this is something that they will be able to milk and get a lot of return before anybody even catches up to them. And that's something that should reassure long-term investors. Over its history, ASML has been quite good at returning value to its shareholders. They've consistently paid off dividends for their shareholders, and they even have actually quite a lot of margin to reallocate some of these payouts for their investors. ASML over the past 12 months have allocated over 35% of their earnings in payback dividends for their shareholders. They could reallocate this money to invest in more R&D, but they've chosen to give back to their shareholders. So this gives ASML quite a comfortable situation in terms of capital allocation. So based on all of that, I actually did a DCF valuation for ASML. And if you'd like to have such a tool directly available on Explain the Stock platform to do some DCFs valuation on some of your companies, let me know. We might be working on that feature next and release it in the next release. But here are my assumptions for ASML. I've assumed that their annual growth was going to be 12%. And this is a fairly conservative assumption. 12% over the next 5 years. Last year they grew 26%, so this is quite a conservative estimate. I've assumed that they will be able to maintain their 30% operating margin. They do have price power. Their technology is proprietary, so I don't expect them to decrease their margins as a result. I've applied quite a conservative discount rate of 8% to reflect the industry risk as they were brought up in the earnings transcript. And I've used a standard terminal growth rate of 3%. And with all of those assumptions, I've reached a valuation of around $310 billion. And that gives a 14% upside to the current price tag. In fact, the price tag at which we reach for that valuation is around $800. So that's a decent return compared to where it's at today, around 705 at the time of this video. So it's quite rare, especially in the semiconductor space, to find a valuation purely financial with very little fuzzy estimate around hype and forward-looking statements, to find a DCF that comes above the current valuation of companies in the semiconductor space. But it is the case for ASML. And that's why for me ASML is a strong buy today. And that's a wrap. I hope you've enjoyed this episode, and if you'd like to learn more about other semiconductor players out there, feel free to check out explainthestock.com, sign up, or use the logged out view to look at these companies, and drop us a comment if you'd like us to do an analysis on another company next time. Don't forget to like and subscribe, and I'll see you next time.